Okay, class. This is a new topic about topic 8, bank assets and liability management. Okay, how bank manage their assets and liability. In this topic, the most important is at least you understand what is the difference or category of asset and liability, fixed rate asset, variable rate assets. Okay, and then how bank manage and the theory related. Why bank needs to manage asset and liability? Why is important? Because in managing asset and liability of the bank, it will affect the liquidity and profitability of the banks. As I highlight in prior class, okay, when we manage bank operation, they always concerned about their liquidity and profitability. Okay, you must relate to this. So what it means by liquidity, meaning that how fast bank can turn to cash their assets without heavy losses. Okay, meaning that if the asset if the loan supposed to be 100,000 when day one, or if the short-term investment like T-bill value 100,000, maybe they need money, they can sell the T-bills getting around 100,000 or a little bit lower than that. Okay, not heavy losses. So that's we call liquidity. Okay, can be turned, asset of the bank can be turned to cash without heavy losses and sold easily and has ready also stable market for the assets. Okay, so why they need bank have why bank need to have adequate liquidity? Okay, to fulfill withdrawal demands. Okay, because if the bank did not have cash, did not have enough liquidity, suddenly there is a large withdrawal demands, maybe bank affected bank operations, bank need to borrow from others. What if bank cannot borrow from others on the spots? Okay, this can make the bank image, this makes will affect bank image. Okay, because showing that they don't have money. So that's why they need to manage their asset and liability properly to ensure they have a good level of liquidity. Okay, not only withdrawal demands but also can fulfill the loan demand. So this is the main operations activity of the banks. Okay, liquidity is very important. When we talk about liquidity of the banks, the most important is you need to know liquidity is to meet withdrawal demands and also to fulfill the loan demands, because loan is the main activities of the bank to generate income. Okay, if bank can maintain their liquidity with a good management in asset and liability, so it can maintain their profit or improve their profits. Okay, where profit of the bank usually measured by net interest margin. When managing asset of the banks, the issue in managing asset of the bank, how to distribute different category or different type of assets to maximize the profits. Okay, however, in managing this asset to maximize the profit, they need to consider the liquidity. Okay, different type of asset, meaning maybe the what is asset, the main asset of the bank is loans. Okay, different category meaning short-term category, long-term categories, business asset, I mean business loan, personal loan, individual loan, household loan. Okay, this time, okay, long-term loans. Okay, this type of assets have different returns. So how bank want to distribute how many percent commercial loans, how many percent investment, how many percent short-term loans, which can maximize the profits. Okay, in managing these assets, bank need to consider about liquidity, because even though they try to maximize the profit, they need to also consider or did not ignore the liquidity levels in the banks. Okay, this is because if bank try to increase the profitability by granted more loans, okay, it will reduce the risk. Okay, so reduce the liquidity. Okay, meanings when liquidity level is low, high liquidity risk. Okay, so the liquidity are related to liquidity risk. Okay, how bank want to reduce, okay, the risk but gain profit. So basically, if the banks, when they manage the asset, they try to reduce the liquidity risk, meaning maybe they keep a higher fund in the bank operation. So this will reduce the liquidity risk. But when keep too much funds in the operation, it will affect the bank cannot granted use the fund to granted the loans. Then it will affect the lower profits because they're supposed to gain high profit because they can lend more money to the people, but they keep a lot of fund in the company, in the bank, so to reduce the liquidity risk, but it will affect the low income because bank cannot generate income from the funds. Okay, because they just keep in the company. So so in other words, if bank need uh, more profits, they need to lend more money, which is uh, they will expose to the high liquidity risk. So because of this, they need to manage the asset properly. Okay, because the liquidity, the adequate liquidity, okay, the adequate levels or appropriate level of liquidity is not only important to the customer but also to the supervisor of the bank, because they need to have adequate level of liquidity to ensure that the customer can withdraw the money anytime, the customer can borrow money from the banks, and they also need to maintain their liquidity to fulfill the requirement of central bank in Malaysia, because they need to fulfill the liquidity ratio requirement in maintaining the bank operations. So basically, in managing asset management and also liability management, there is LP dilemma, meaning liquidity and profitability dilemma. If they focus too much on the liquidity, they will get but low profit. But if they focus too much on profitability, they will high or increase their liquidity risk. So what type of asset they are managing or bank manage? Okay, bank not only manage, okay, as we know, the main asset of the bank is loan. Okay, so they not only manage the loans but all the assets. Okay, because they can do uh, mix, they can manage the asset, because some different asset, for example, like cash and short-term fund. Cash and short-term fund very liquid. Okay, loan and advances are main assets. The asset is important to generate profits. Okay, trading security also can generate profits. Okay, so all this type of asset, they have different function, different profits, and different liquidity. So this is what is the asset, what are the assets that will be managed by the banks. They not only manage certain type of asset, they will consider all type of assets. They will check on their liquidity and how it can generate income to the bank. Okay, how about liability management? How bank manage their liability? Okay, so when bank manage liability, what is the meaning of manage the liability? They need to, what is the liability of the bank? We divide to two categories, right? The main liability is deposit, okay, and the another activity liability is non-deposit borrowing. Okay, so it involves banks borrowing activities in the financial market in order to get bank liquidity. Okay, that's why it's very important. You can see it's also related to liquidity. Again, in managing liability of the bank, they also need to consider about liquidity and profitability. For example, if the bank did not have enough fund, okay, meaning they have a liquidity issue, what they can do is they need to borrow from the financial markets. Okay, financial market, or for example like repurchase agreement. Okay, so this type have different type of liquidity, okay, different interests, which will affect the profit of the bank, because the higher the interest will affect the lower the profit of the banks, okay, because this is liability. So again, they also, when manage liability, they also consider about liquidity. For example, how fast they can get fund from borrowing and how much they charge, okay. So they will manage all different type of liability, okay. For example, maybe they need long-term funds. So long-term fund, because they need long-term fund because they need that money to lend to the borrower of long-term loans and allots, okay. So they cannot just take it from the deposit money, because deposit money is fluctuate, okay. Because people can withdraw anytime, so they need to borrow, and then need to borrow, cannot borrow from the short-term financial markets, okay. They need to borrow using the long-term financial instrument, so that they can lock the long-term sources of fund to lend the money to the long-term borrowings, okay. Okay, when we talk about liability management, okay, liability is consists of deposit and non-deposit borrowing, okay. Deposit also liability. So the main sources of the bank is deposit, from liability from deposit, okay. So what is the factor? Okay, this is not related to asset management chapter, okay. This can be this also can relate with the financial statement of the bank chapter, okay. What is the factor affecting deposit levels, okay. What makes a bank deposit level higher than the other banks, okay. So there is 7 factor. Number 1, this also is possible question come out for your exam, possible, okay. Number 1 is competitive interest rate. Okay, the higher the bank offer the interest rate to the depositor, they will attract more depositor put money in the banks. Okay, for example, if Maybank offer 2% annually for the deposit interest rate, compared to the Affin Bank, they offer 1% annually for depositor. So people will invest or will keep their money or deposit their money in the Maybank compared to the Affin banks. Okay, so that makes the Maybank deposit level higher than Affin banks. Okay. Factor number 2 is staff and other physical aspect of the banks. Okay, for example, the staff of Bank A is very good, okay, very understanding and knowledgeable, okay. So this can also affect people to put their money, okay, in the Bank A. So okay, how the staff train, okay. And then number 3 is service offer to the bank. Just now staff about customer service, okay. Staff, for example, they entertain the customer very polite, very kind, okay. But number 3 is service offered by the banks. For example, there is a different type of deposit. Maybe bank offer if you put money different product related to the deposit. If you put money in deposit type A, you up to 1 million or 100,000, you can get some bonus or some other gift. Okay, that's offer. Okay, maybe if you want to deposit money or any other services are very are better than other bank, will attract depositor to put money in the banks. Okay, another example is rather than the customer need to queue for longer period, but they can make appointment, for example, to deposit their huge amount of money. Okay, and nowadays they have ATM. Maybe a lot of ATM machine can make easier for people to deposit money. They also can increase the deposit level of a bank when they have better service than other banks. Okay, number 4, key strength and policy. Okay, key strength and policy of the banks. Okay, for example, this also about policy. Okay, maybe they can do a joint venture deposit accounts, or deposit account can be considered personal and business. Okay, and then if they have personal account, maybe they also can create business account. Because certain bank, when you would like to open account, bank account for the business, you need to have recommended by other depositor or other account holder, business account holder. Okay, but it maybe can attract more depositor to a bank if they have policy. For example, if the owner of the business, okay, have account, but individual account in the bank, suddenly the owner suddenly they want to open the account for business, the bank can allow that. Okay, uh, and then maybe they give higher interest rate. That is a policy when you have several type of accounts. Okay, and then this is the product offer also. This is the type of key strength on policy that can attract people to put money in the banks. Okay, so increase the level of deposit of a bank compared to other banks. Okay, the number 5. Okay, number 5 factor related to the economic activity levels. Okay, so usually during the good economic activity, meaning uh, when good economic conditions, people will put money more in the banks. Okay, because they have money, they can generate income, so they can put money in the bank. Compare during the um, slow down economic activities. Okay, so economic activities, this is external factor. Economic activities also uh, can affect the deposit level of a bank. Okay, when economy in good condition, people have a lot of money, so they put money in the banks. And then location also affects the deposit level of the bank. If the depositor prefer to put money in the bank, if they found that easy and very near. Okay, easy because very near to their place, so that easy for them to deposit money. Okay, and lastly, this is no doubt early establishment effects. Okay, so the earlier the establishment of a bank will have more deposit compared to the recent banks that just opened, because when you are the pioneer, when the bank is established long time ago, there is a lot of customer because they are pioneer. They started collect deposit from the customer. Okay, the customer know them and know the performance of that bank compared to the new banks. Okay, so that's why their deposit level will be higher than just established banks. Okay, okay. We know when we manage the asset and liability of the banks, okay, the dilemma in managing the asset and liability is liquidity and profitability. Okay, so by managing this, usually bank will follow, okay, to solve this dilemma, bank will follow the three methods, okay, or three approach. Uh, because these three approach are related to the liquidity and profitability, okay, which is risk and return. Okay, when we talk about liquidity, it will affect risk. Okay, return is related to profit of the banks. So the approach is, there is three approach, but we will discuss about two approach only: fund pool method, okay, asset allocation methods, and also linear programming method. Okay, linear programming method meanings in the system. Okay, they do some uh, formula, so they come up with how many asset, percentage of asset for different type of assets. Okay. Okay, what is the meanings of fund pool approach? Okay, fund pool approach. Pool meaning the words pool. Okay, they combine all the funds. Okay, for example, what is the asset? Okay, a fund, all fund put in a saving, in a saving. Okay, a saving, and assume from the same source of fund. So that's the meaning of fund pool approach. Okay, meaning all fund they put in one saving and assume that is come from another one sources. Okay, so this have pro and con. The pro is easier because you assume they come from one sources. However, it's not come from one sources. Your fund can become from the deposit and non-deposit. Okay, your fund can become from the short-term deposit, long-term deposit, or different type of borrowing. Okay, so this approach they assume all that fund, either they're borrowing or not, or different type of borrowing, they assume it's from same, so they just want to know how many fund they have. Okay. Okay, after they know how many fund they have, so what they do is they distribute the fund based on the priority of asset category. Okay, because they need the fund to manage the firm, right? To manage the bank, to lend the money. Okay, to lend the money short term, long term, to invest. Okay, to generate profits. Okay, so from the same source of fund, the assuming this same source of fund. Okay, for example, like 100,000. They assume 100,000. Okay, they don't consider uh, the different type of funds. Okay, so they from that 100,000 they divide the 100,000 to their purpose of asset. For example, the main reason. Okay, the main reserve. Sorry, the main reserve 30%, secondary reserve, which is short secondary reserve related to uh, investment in short-term security. Okay, and then loan portfolio, meaning they will lend the money 30%, and the rest they will do long-term investment in subsidiary or in fixed assets. Okay. However, this approach have disadvantages. Okay, has disadvantages, meanings. Okay, they will focus on liquidity. Okay, because they only focus on liquidity, meaning they need to have a lot of fund. Okay, so meaning that the purpose is they just know they only need a lot of funds so that they can fulfill the liquidity level or to ensure the adequate level of liquidity. Okay, so that's the meaning of focus on liquidity. Another disadvantages is not standard measurement of liquidity, meaning that how liquid, because you just know that you have a fund. Okay, so meaning the higher the fund, meaning the higher the liquidity. Okay, but you did not consider, okay, different type of sources have different type of liquidity. For example, like deposit. If deposit, okay, the liquidity is high or low? Low liquidity. Okay, but now they assume similar liquidity because they pull in one sources, okay. And the third one is they not consider the volatility of deposit account. This is very important, okay, because since they assume all the sources come from the same sources, deposit from the same sources, they don't consider either short term or long term. And then the borrowing also, they don't consider about long term borrowing or short term borrowing, so they assume the same sources. So this will affect problem of the liquidity management. And then they not consider the volatility of the fund, for example volatility of the deposit account, because deposit account very volatile. The depositor can withdraw the money anytime, so it's volatile, okay. So that's the disadvantages of this approach, because they consider from the same sources, okay. Okay, that another approach is asset allocation approach. Okay, this approach try to mitigate the weaknesses of pool fund approach just now. Okay, so this approach different because liquidity and profitability decision are made separately and individually for each source of fund. So they realize that each source of fund have different liquidity and different profitability. Okay, so they try to mitigate pool fund approach because they realize that every source of fund have different liquidity and profitability. So they separate that source of fund. Okay. So they establish the achievement of bank and changes of bank fund, for example, the repos or floating NCD. Okay, this approach they start establish that or consider the bank uh, changes about the fund changes, especially the volatile, for example, like repurchase agreement and also floating NCD. And because they realize of the different type of funds, they use matching concept. Okay, so this asset allocation approach, they use matching concept. The meaning of matching concept is asset must be financed by liability that has similar maturity period. For example, if the asset long term loan, okay, long term loan is asset of the bank, so the sources of fund to granted long-term loan to the borrower must come from the long-term sources, which is long-term liability or long-term deposit, meaning fixed deposit. Okay, so this is example. So most of current deposit will assign for main reserve and secondary reserve. So if the current deposit and the normal deposit like saving accounts, okay, usually this fund from the deposit account, especially saving and also current deposit, they will use this fund to cover the requirement of primary and secondary reserve because they are very volatile. Okay, so this is the meaning of to matching the maturity period of liability and asset. Okay, however, the disadvantages of this fund, they are not recognize loan as sources of liquidity. Meaning what? They not recognize loan as sources of liquidity. However, when bank actually granted loans, bank will get back the repayment, right? The repayment amount monthly. Okay, so they not recognize this repayment amount. The part of repayment is interest, right? Principal and interest. They not recognize this repayment amount as a sources of liquidity. Okay, so because of that, they are overestimates. Okay, their liquidity. Okay, they only focus on they overestimate if they overestimate examples because they believe they match the liability and assets. Okay, they match the source of fund with the asset, so they believe the liquidity is at adequate levels, but this can be overestimate because sometimes the sources of fund can be reduced suddenly, okay, especially for the saving accounts, okay. And again, even though they mesh the sources of fund with the assets, okay, the maturity of sources of fund and the assets in managing this approach, okay, but basically this concept still show or reveal that banks still manage the asset and liability separately, okay. They focus on asset only, okay. Then they try to match the asset with the source of fund, so still source of fund with similar maturity, so meaning that banks still manage the asset and liability separately, okay. Okay, when managing the asset and liability of the bank, we always concerned about the liquidity. So what is the function of liquidity to the banks, okay. Actually, there is a factor that makes the bank liquidity is very important, okay. There is a 5 factor. Number 1 is confidence factor. What is the meaning of confidence factor? Meanings, when bank have adequate level of liquidity, it can show that can can increase the public confidence of the bank, meaning public can put deposit money without any issue, okay, because they know when they put the money they can withdraw the money anytime, okay. If they want to borrow money, okay, also possible, okay. That is the reason why the factor why bank need to have liquidity level of adequate level of liquidity. Factor number 2 is about relationship factor, okay. When bank have good liquidity, meaning they have enough fund to lend the money to the customer, okay. Enough fund to fulfill withdrawal demands, okay. So this can maintain or increase relationship between the bank and the customer, okay. The third factor is forced sale factor, okay. So if bank did not have enough liquidity, bank need to sell their asset, okay. For example, bank need to sell their T-bills so they can get cash, okay. So sometimes if bank need to force sale, for example, they need the money urgently, okay, what they can do is they sell maybe their subsidiary, maybe their fixed assets falsely, okay. So when they for sale, so whatever value uh, paid by other party, they need to accept because they need the fund immediately. So it will make bank okay, lost some money because for sale and they need to accept any value offered by other party, okay. So because of this, false sale factor will make bank lost some profit, okay. So bank will make sure their liquidity level is adequate for their business operation, okay. Factor number 4 is risk premium factor. The risk premium factor meaning that if your bank is lower liquidity, okay, and then meanings you have lack of funds, okay, meaning that your financial condition is not good, okay. So because your financial condition is not good, and then when you want to borrow money from other bank, they will charge you higher because you are higher risk, your bank is higher risk. So the other bank or the other institution, that if you plan to borrow money from other bank or from other institutions, okay, they will charge you higher interest rate, which is high risk premium, because your bank is higher risk. There is possibility you cannot pay the money back on times, for example. So that's why a bank, they try to maintain the adequate level of liquidity so that when they want to borrow money from other party, they will not charge by higher interest rate. Okay. The last factor is last chance factor. Okay. Last chance factor meanings, you remember the last chance, the last resort of the bank to borrow money is they can borrow money from the central bank, BNM, Bank Negara Malaysia. So if you do not have adequate level of liquidity, so is showing that you have operation problem or financial problem. So when you try to borrow money from the central bank may be reluctant to lend money to your banks, okay, because they believe that you have a liquidity problem and to pay back the money that you borrow from the central banks. Okay, that's the factor, the last factor. So when a bank they manage their liquidity, okay, because when they're managing asset liability, it will affect liquidity. Okay, so there is a theory of liquidity, okay, related to the bank management. Okay, if based on the commercial financial theory, okay, number one, theory of commercial financials. Okay, this theory highlights to maintain the liquidity of the bank. Okay, bank can increase their liquidity when they only have loan portfolio consists of short-term loan financing. Why? Okay, meaning that if bank they lend the money to the borrower, they only borrow short-term loan. Okay, so because of in the short-term period less than 1 year, bank can get back their money. Okay, so this will maintain or improve the liquidity of the bank. Okay, so this is commercial financial theory highlight about liquidity of the bank. Okay, bank only lend the money or the loan portfolio consists only short-term loan. Okay, and then the second theory is about shiftability theory. Okay, this theory mentioned that banks can maintain their liquidity, not only have a short-term loan portfolio, but also banks should invest in securities secondary markets. Okay, the meaning of secondary market, because of securities in secondary market very high liquid. Okay, so anytime they can sell the security and get back the money or to increase their liquidity. Okay, meaning that the short-term loan portfolio, okay, bank can increase their liquidity by having short-term loan portfolio and also invest in security of secondary market. For example, like invest in T-bills. Okay, T-bills also have secondary market because they can sell T-bills to other banks, other financial institutions. Okay, secondary market should highlight that the security very liquid. Okay, and then the third theory is expected income theory. Okay, in this theory, bank can maintain their liquidity. Okay, by consider that liquidity they can gain via loan repayments. Okay, so this is the disadvantages of asset allocation approach, right? This theory highlight about a bank to maintain liquidity, they need also consider the liquidity that can be gained from the loan repayment, because when people pay loans, at the loan repayment there is principal plus the interest. Okay, so the interest is expected income. Okay, so that's the meaning of this theory. Okay, liquidity can be gained by using loan repayments. Okay, and then the last theory is about liability management theory. Okay, liability management, liability meaning that this theory highlight if the bank they want to maintain their liability, they can borrow from the money market or capital markets. Okay, meanings that's why if you look at the bank financial statement, there is the source of income, the source of bank borrowing and non-borrowing. Liability is borrowing and deposit and non-deposit. Non-deposit is borrowing, right? Okay, so borrowing from who? From the money market and capital market, from the short-term market, short-term financial instrument or long-term financial instrument. So of course, okay, when you did not have money, you borrow money from other party. Okay, so liability, that we call liability. When you borrow, meaning banks have increased their liability. By increasing liability, meaning bank increase their fund, so can increase the liquidity level of the banks. Okay, what is example of money markets? Like money market, like repurchase agreement. What else? What else? Money market instrument. T-bills. T-bills not money market instrument. That's not liability. That is investment. What else? Money market instruments. Okay. Long-term bond. Okay, that one is capital market instrument. Okay. Banker acceptance. Okay. Negotiable certificate deposits. That's example of liability. The application of liability management theory. So in maintaining the liquidity of the bank, they have several measurement bank can refer. Okay, so this measurement on this slide, this measurement all they can refer. They not only use one measurement, they will use several measurement to check on their liquidity. Okay, this is example of liquidity measurement that bank use. Okay, previously what we learned that bank focus only asset management or liability management. Okay, but when they only focus asset management or liability management, when they focus separately, when they manage asset and liability separately, there will be a issue, there will be a problem when manage asset and liability separately. So after 1980s, okay, bank decide not to depend solely on liability management, not solely on the asset management. They want to manage the liability parallel with the assets, because in managing business, okay, there is involvement of investment decision and financing decision. Okay, asset management means investment decision. Bank need to manage the asset, okay, because they invest, actually they lend the money to the borrower, they can get income. Okay, they invest in securities, financial securities, they can get income. So that means investment decision, how much, how many. So asset management actually related to investment decision to create profit. But how to fund the investment decision, how to funding the bank investment, so that one is related to liability management. Okay, if bank did not have enough funds, they need to find another fund from outside, meaning they borrow money from others. So to manage these borrowings, we call financing decision, to finance bank investment. Okay, so both of decision, investment decision are related. So that's why bank need to manage asset and liability parallelly. Okay, at the same time, cannot focus only one, they need to do together. Okay, this is because management must consider the cost and return of each sources. Okay, if they use, for example, short-term borrowing, what is the cost, the interest rate charge, if this interest rate high or low, whether this interest rate can affect the return of the bank. Okay, so because each source of fund when determining the right mix of fund, because they cannot refer only one source of cost. For example, if they only depend on source of borrowing cost is very low. The low cost of fund is come from borrowing. But if the bank focus or only have fund from the borrowing, it can affect the volatility of the liquidity, because borrowing is very high volatility. Anytime depositor can withdraw the money, and bank, if the depositor withdraw the money and bank did not have any other source, bank can have high risk of liquidity because very lack liquidity, okay, lack of fund. So that's why asset management and liability management involve different decision, but the technique to engage the asset and liability management uh, same objective. What is the objective? Okay, the objective is to increase the profit of the banks, okay, which is increase the profit and maintaining the liquidity of the bank, okay. Even though they different decision, but they need to be managed parallelly, okay, because they have the same objective, okay. So if managing asset liability, they try to achieve the same objective, right? So what actually the objective of the bank? Okay, as I mentioned, the main objective is to ensure bank have maintain or adequate level of liquidity, because okay, when they have adequate level of liquidity, they can fulfill withdrawal demands when depositor want to withdraw their money anytime, okay. And with the adequate level of liquidity, bank has sufficient fund to fulfill the loan demand, okay. Bank easily can lend the money to the borrower, okay. So this can maintain relationship between customer and the banks, okay. And this can ensure when they can bank has sufficient amounts to fulfill the loan demand, this can maintain, or this can create the income of the banks from the loan interest that they charge to the borrower, okay. This is how how you can explain the objective of asset and liability management. It consists of liquidity and profitability. Okay, however, in maintaining the liquidity and profitability, in maintaining the asset and liability management, and they refer to the fund gap management, okay. What is the meaning fund gaps? Okay, managing the interest rate of the bank asset and liability, okay. So the interest rate of the bank asset is the income of the bank, the interest rate of liability is cost to the bank. So they're managing this, okay. In managing this, okay, they need to know whether the interest rate are fixed rate or variable rates, okay. What is the, because it will affect the fund gap, okay. So what is the type of fund gaps, okay. What is the meaning fund gap? Okay, fund gap because the difference between interest rate of bank asset and interest rate of bank liability, okay. So we have positive fund gap and also negative fund gap. What is the meaning of positive fund gap? Okay, positive fund gap when variable rate asset financed by fixed rate liability. Variable rate asset, what is example of variable rate assets? Okay, what is example of variable rate assets? Okay, now you need to know, okay, the meaning of variable rates and fixed rates. Variable rates meaning the rate, interest rate for short term. Fixed rate, interest rate for long term. So we call fixed rate liability or fixed rate asset meanings rate related to long term asset or long term liability. Because long term asset meaning when you charge long term loan 8% for 10 years. So you can gain 8% interest rate for 10 years. So you lock fixed rate for the 10 years long term. However, with variable rate assets, okay, every 1 year the interest rate will be changed. Every 1 year the variable rate will be changed because variable rate is short term asset. So if for example you lend the money now for 1 year, okay, less than 1 year, you charge your borrower is 10%. In the future, maybe you cannot charge 10% because the market interest rate are fall, Okay, when the market interest rate decrease, you also need to reduce your interest rate charge to the borrower for your short term. So in the another 2 years, suddenly the market interest rate increase, so you can charge higher again. Okay, so this is why we call short-term asset or short-term liability is variable rate asset and variable rate liabilities, because the rate will be changed from time to time, depends on the affecting by the market interest rate. Okay, so positive fund gap when your variable rate asset financed by fixed rate liability. Okay, meaning if you can finance your variable rate assets with lower fixed rate liability, this can have, because this can have bigger fund gaps. Okay, because you can lock the rate for longer times. Okay, so we have different type of asset. Okay, as you know, the different type of assets, either matching rate, variable rate, fixed rates. Okay, matching rate when interest received. Okay, interest received meaning interest rate from assets. Okay, higher than interest rate expenses. Okay, that is matching rates. Variable rate asset. Okay, matching rates, very good. You can get positive income. Variable rate meaning that I mentioned just now, short-term rate. Okay, it always changes. Example of variable rate asset. What is example of variable rate asset? Short-term loans. Okay, credit cards. Okay, variable rate asset. T-bills. Okay, and then okay, and example of variable rate liabilities. Variable rate liabilities, you go to the liabilities part. Okay, for example, saving accounts or bank acceptance, negotiable certificate deposits. Okay, repurchase agreement. Okay, example of fixed rate assets, long-term loans. Okay, fixed rate assets, property. Okay, long-term investment in bond, for example. Okay, when you invest in bond, that become your fixed rate asset. When you finance the banks, when you issue bond, meaning that it's fixed rate liability. Okay, so that is some example. Okay, fixed rate. Okay, usually when you, sometimes question will ask you, what is the, give example of fixed rate asset or fixed rate liability. Okay, make sure you know. Okay, related to long term, either long term asset or long term liability. Okay, in managing the fund management, you need to consider about the interest paid and interest received. So bank can gain return when their interest received are higher than interest paid. Okay, so for example, when you expect the market will keep increasing the interest rate, you need to invest in more variable rate asset financed by fixed rate liability. Okay, meaning that you invest in short-term asset, or you give more loan on short-term loans. Okay, because in and financed by the fixed rate liability. Why we want to finance by fixed rate liability? Okay, for example, now it's 8% interest rate. You charge your variable rate asset 8% and also financed by 8% liability fixed rate for 10 years. Okay, so this 10%, okay, sorry, 8% liabilities, 8% cost, meaning to finance 8% income. Okay, the 8% cost, interest cost will be similar for 10 years. But the 8% income, okay, only for this year. Next year, if you invest again in your variable rate, the interest income on your variable rate asset will be increased because interest rates are increasing. Okay, so if next year the interest rate 15%, you still finance using the fixed rate liability, which is you have locked the cost at the previous year, lower than that. Okay, so this can make gap between 50% and 10%. So you gain profit, or the bank gain profit 5%. Okay, this is how they manage. Okay, on the other way, interest rate decrease. When interest rate keep decreasing, market interest rate keep decreasing, meaning that you need to reduce your variable rates. Okay, meaning that reduce your variable rate asset. In other words, you need to finance your you need to invest in fixed rate asset, because you want to lock fixed rate asset your investment at 8%. In the future, if the interest rate decrease to 5%, you still get 8% because you lock the investment for fixed rate assets. Okay, and then you should reduce financing using fixed rate liability. Because why you need to reduce by fixed rate liability? Because you try to get lower cost. Because if you use fixed rate liability, it will be fixed for the longer period, even though the interest rate decrease. So you need to reduce your financing using fixed rate liability. Okay, because it can reduce your cost. Because if you take a variable rate liability, for example, from year to year, the variable rate cost liability will be lower, so better than that. Okay, so it's same application to the highest interest rate. When a market have the highest interest rate, meaning achieve the peak levels, and you expect the interest rate will be decreased. Okay, so when you expect the interest rate will decrease, the same application with the time interest rate decrease. Okay, so you move your long-term security investment. Okay, but when the interest rate at the market at the lowest interest rate, in the future actually the interest rate will be increased. So the concept will be similar to manage the interest rate decrease. Okay, so the concept of lowest interest rate similar like interest rate increase, because after lower interest rate we expect the interest rate will be increased. Okay, in the conclusion, in manage asset liability, they need to manage together. Okay, parallelly. Okay, so bank always to maintain the positive fund gap. Okay, they need to remain positive fund gap so they can gain profits. Okay, so the gap size between interest rate depends on the economic conditions. Either the economic condition is good, so it will affect the interest rate, so it will affect the gap size. Okay, so in the main problem in managing asset and liability actually is managing the interest rate. Okay, because it affect the rate, market interest rate. Okay, you need to consider the interest rate because it will affect the liquidity and profitability of the banks. Okay, so to reduce the interest rate when managing the asset and liability, okay, you need to use the fund gap management. Okay, the interest received should be higher than interest paid. Okay. Okay, that's all. You have a question for revision. Maybe you need to answer in the forum. Okay, thank you.